Hello, Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh. My name is Dr. Khairi Hassan, the economic expert and company secretary. Today we are going to present the third quarter financials for DFI for the third quarter for year 2023. I have my colleague, Mr. Balginder, the financial CFO of the group. He will present the financials for the third quarter, which has been already uploaded in the MSX on 9 of last month. So you can start the presentation, and after that we will have any question from the audience.
So shall we wait 1 or 2 minutes more?
I did the presentation. You start,
Okay. So good morning. We welcome all the shareholders, investors, and analysts for the Q3 presentation of DFI Group. Right? We start with a short summary how we appeared till 9 months in Q3 and the Q3 at a standalone level. So as we interacted 3 months back, we shared that Q3 should be a better as we are seeing the lesser Kharif impact on the financials and business is stabilizing, prices are cooling, and the company and the board is doing a lot of transactional changes, operational changes, and strategy changes at every corner and every segment in the business, right? So we start with the financial. We hit a turnover of 26 million, 26.29 million, which is 13% growth versus the last year at the same levels. If you understand, the Q3 is a Kharif period in Salala, which impacts humidity, which impacts the sales in terms of our feed mill, but still we delivered a 13% growth in volume, which shows the sustainability in the business. At a gross profit level, we are 58% higher than the previous years. Almost, I would say this is a significant performance. How and why it has happened, we have been able to maintain our selling prices. At the same time, there is some cost reduction strategies. We will share this in the second slide. At net profit, we are positive, almost 1 million versus a loss of 1.39 million last year. We have some one-time write-offs last year, which because of which we have a losses. We are trying to ease out the working capital pressure as the finance cost overall is increasing. Right now, the CBO lending rate is more than 6%. So we are focusing on how we can reduce the financial cost and the requirement of working capital. The snapshot of this will come further also when we go to cash flows and the balance sheet. We are looking for wastages as we are more a retail company. So we have to look the process improvement in terms of supply chain, in terms of production, wastages. So this is what we are highlighting and what we are doing now. If we go to the operation side, we see that the dairy price increase we implemented in February, almost 15%, and this has happened after 15 years. We launch a healthy product, which is a non-sugar product in July. And the impact of this is we can avoid the excise duty by almost 80%. So there is a 80% reduction in the excise duty due to non-sugar launch of non-sugar juices. There is a higher customer reach and connect. So what we are focusing right now is to reach to the end customer, what are their issues, concern, and to solve, to get a better understanding what we should do in terms of increasing our market share and understanding. Procurement transformation, depending upon the seasonality. Sometimes we may take a positional call, sometimes we staggered it. But the idea is, if you see on the left-hand side, we are seeing that lesser working capital. And if we mix with the procurement, that means what we have to do here is to have a backward integration with the supplier, more commitment, long-term basis with the suppliers, and lesser LC, lesser CAD payments, and lesser inventory at our level, at a DFI level. Then we focus our farm, because farm is the area, if we maintain our farm properly, and if we know our cows, our breed, our biological asset are increasing, my milk cost will reduce. So we are doing some OPEX and CAPEX in farm, and focus on automation and process improvement. As we measure more and more, as we review more and more data, we get a scope to improve. And with this all improvement, it will result to the financial gains. Moving to the financial slide, second slide. So what we are showing here is we are showing the quarterly, how in quarterly we appeared. So we started with a challenging quarter in quarter 1. Why it was challenging? Because the world is coming out of the supply chain crisis. The bull wave impact was huge. The shipment cost was huge. People were sitting in inventory. The raw material price was skyrocketed. We started when the raw material price was almost 40% higher than the normal average of 40 years. So the quarter 1, we delivered a sales of 8.5 million. Quarter 2, it increased because of Ramadan impact, and quarter 3 still higher than quarter 1. Even though we faced a Kharif impact where our feed mill business dropped by almost 50%, but still we maintained the sales. So this is where the company has focused in quarter 3, how to reach to the maximum number of customers and how to integrate their demand with our sales, right? So we are purchasing according to the demand, and we are delivering maybe at our cost only as to serve the society. Our GP margins have been consistently increasing in the last three quarters. Again, it is an impact of the next line, which is called a direct material consumption to sales ratio. If you see, there is an impact of like 6% saving versus the quarter 1. So this translates into the profit, GP. But the increase in GP is more than the saving in the raw material cost. That means there are other direct savings which has come. Now, from where the other direct saving has come is like the manufacturing cost. We have removed some of the loss-making SKUs where we were seeing like a 50%, 70% losses in manufacturing and the wastage. We have optimized our labor. We have changed the strategy of production. We have again reviewed the processes, production processes, the batch manufacturing, everything has been reviewed, and it will go on increasing going ahead. Net profit from loss, we deliver to the profit. So this was the first quarter, I think after 4th quarter, where we delivered the positive net profit, and it was operational profit also. So it was a cash profit, operational profit. And in quarter 3, we, from the board, in the regulatory, we appreciate, we thank all the regulatory authorities for timely approving our OGFC takeover, which was a strategic move to strengthen the balance sheet of company, the assets. Why OGFC takeover is important for DFI is because most of our suppliers where we get the sourcing, our import, we are doing from world like South Asia, America, we are buying the product. European countries we are buying. Both the companies are having same suppliers. So there is a lot of benefit of synergies, which we are targeting with the largest base of demand or a production, we say. Again, our distribution channel is almost same. Our target customers are almost same. This is where we can bring lot of synergies. So in quarter 3, we closed the deal. This was the private placement, and going ahead, this will bring lot of synergies, positive synergies to the DFI also. And we expect now what we should expect in the quarter 4. We want to share that we believe the quarter 4 will be still at par or better than the quarter 3. There won't be any surprises. We are almost in the mid of quarter 4. So we see the quarter 4 should be equal to or better than quarter 4. And we have some visibility of our procurement cost. We know our sales. Now we are moving out of the Kharif season. So the feed mill demand will pick up. Consistency in the dairy side will be there, and our cost is under control. So we expect a positive, better quarter 4, and we will end up a year at a good note. Let's review how we appear now in terms of ratio. More our ratios are focused on the liquidity working capital, as we all aware that the funding cost has increased and we are depending upon the banks for the funding. Our current ratio is significantly improved. At the same time, there is improvement. Now we are almost at a 70 basic point. Idle is 1.2, so we will continuously see an improvement here as we are controlling our working capital needs. The working capital requirement has significantly came down. This is how we are trying to reduce our cash to order cycle, order to cash or cash to order or cash to conversion cycle. Procure to pay cycle we are managing. As we reduce the cycle, cash turnaround or cash conversion cycle, we will see the lesser working capital requirement. And every reduction in a working capital requirement, every million saved here will give me like a 7%, 8% saving, which will be directly coming to my P&L. In terms of quick ratio, we see again a better here, higher, I would say 30% improvement here versus last year. Now, why again here? Quick ratio is majorly depending upon my inventories, my liquid assets, my bank balances. So we have controlled the inventory. We will see going ahead. Somewhere we are building inventory on a strategic move to get the price benefit seasonality. But overall, we are reducing the inventory. We are backward integrating with the suppliers. Debt equity ratio, lower is better, lesser debt compared to the equity. We have repaid almost 2 million to the banks in the 9 months. So at present, we have a lesser debt compared to the equity. Operating profit almost break even now, I would say 0.81%. I believe Q4 should be a better. This is a 9-month performance. So Q3 has been positive. Q1 was the highest loss where we made it. Q2 was kind of a break even. So the loss which we see here 0.81% is because of the Q1 where we suffered huge. Interest coverage ratio is better. That means company position is strengthening now. Coming to month on month, there are two lines and one bar. If you see the consistency in the sales, July is a Kharif season, but still we managed to have a good sales consistency sale. August was a better month. September is again an average month. So Q3 generally is a lean quarter for DFI because of Kharif season and lesser demand. Q4 should be better. In terms of gross profit, we have continuously seeing a rising trend. This is all because of the operation transformation which we are seeking. Net profitability, we are last three months, if you see of the quarter, we are positive at net level also. If we are positive at net level, that means we have a positive EBITDA. That means my cash flow stress will be further reduced. And any reduction in cash flow stress will give me ease in finance cost, and it will translate to, again, it is a cycle, economical cycle, vicious cycle, how we do it. Coming to the full level, quarter on quarter P&L, our sales we discussed, there is a growth of 13%. There is a reduction of cost of sales by growth is 8%. That means technically we delivered 5% higher GP because of the cost management. So another aspect where you have an inelastic pricing, where the government controls, you cannot improve the pricing, is to control your fixed expenses. And if you see at a rising volume, at a rising value of sales, we control our admin expenses, we control our sales and marketing expenses. This is all the strategic moves which we are doing it. Because of this, we have resulted a better quarter, going ahead, better profitability and EBITDA margins. So the Q1 EBITDA margin, if you see, was 146,000 negative, where Q2 was positive, and Q3 is some fair value gain also came. But if we ignore the fair value gain in acquisition, still we are positive by almost 90,000. So we expect Q4 to be better, and we will show a better year end compared to the last years. Coming to a group level, so in a group, still we have DPC, the one cycle of circulation from raw material to getting, selling and collected So that is almost 45 to 70 days. And we believe at a group level also in Q4, when we again discuss our audited financials, we will show a better picture. So only there is some capex or some structure changes required at a Dhofar Poultry, which has resulted in a negative here. Other companies, OGFC, Dhofar Beverages, all are positive. But definitely we are confident and we have action plan done. We are changing the structure in DPC. Now we are moving from SAOG to SAOC. To have more operational synergies with DPC, DFI as we done in OGFC. So at a group level, we delivered 37 million. You see a growth of 31% in revenues. Cost increase 33%, so 2% hit in GP. But at you see GP is 13% versus 14%. 1% we try to control from fix other direct expenses. Like production wastages, inventory levels, etc. Still, there is at a group level, there is an increase in admin and selling expenses, which is a concern and which will figure out and solve it, control it in the next few quarters. The rest all is okay. Dividend income is lesser compared to last year's. Fair value gain of 934,000. This is via equity method at a group level. So at the year end, we see a better year end here. We are in transition phase in DPC. Let's move our focus to the standalone balance sheet at DFI level. We want to highlight and start here. If you see the first bucket here, the debtors, small increase in debtor because of 13% increase in the sales, right? It is a proportional thing. Inventories are almost similar level. Like 10% lesser, but the expected is year-end inventory should be much lower than this. This was a strategic move which we taken because inventory prices bottom out somewhere in August. Rest all thing accrued expenses almost similar, nothing big changes here. On the right hand side, if you see, there is a increase in our retained earning by 2.5 million. This bring out the resilience to the company. The financial position is better and going ahead this will improve. So there is no, as we started the year, we feel that there was a risk of changing retained earning to negative territory, but yes, we are able to maintain in the last 6 months. And right now we are doing revaluation of asset as it is required by regulatories and it has not been done. So a better financial position going ahead by the year end we will see. Coming to the balance sheet as a group level, again, the debtors are a bit higher on an exit date compared to this is because of the related party, some transactions. Inventories are under control or improving. But we assure you here that the going ahead, the balance sheet will further strengthen. We have a plan and there is a lot of strategic moves which are being taken place by the board. The most focus area remains cash flow. If you see the cash flow from operating at a group level, it shows a positive of 2.8 million. And if you match this figure with my reduction in the working capital, it's almost similar. So this shows that we released the 3 million cash, almost 2.8 million cash into the operating level. So my requirement from the banks has reduced by 2.8 million, which will further strengthen going ahead. At a parent level, at a standalone level, we have released 4.1 million from operations, which is a good effort by all the operating team. At an investing level, we are doing some capexes which are much needed to bring more efficiencies. So there is some outflow here. In net, from financing activity, we have reduced the bank borrowings. We have repaid the LCs, LTR. So the outflow happened here. And overall, this is compensated from the operating activity and we see a finance cost saving here. Going ahead, it will strengthen further. This is all from my side. Any questions we are happy to take.
Thank you to our CFO, Mr. Balginder. And is there any question about the third quarter performance? I believe that we have done a very good result. The revenue has been increased with 13%. The gross profit has been increased tremendously by 41%, which really is a good achievement. And we are looking forward to have a better result in the end of the year, inshallah, hopefully. So anyone has any question, please, you can ask Mr. Bagender to reply and to answer. Okay, I believe that's all. Thank you for everybody for the attendance. And we hope that we will make our next presentation by the end of the year with a very good result, inshallah. Thank you for everybody and goodbye.
Thank you. Thanks a lot.
Close, huh? Recording is closed.